Good morning, good afternoon, everyone, and happy to see so many of you entering our Health3-2-1 project's second US webinar in here. And just that I'm reminding you that this event will be recorded unless you didn't notice it when you joined the Teams. My name is Tero Piispanen, and I'm part of the project consortia, and I'll start with sharing my screen, hopefully, and explaining a little bit of what our project is all about. So we got an EU-funded project in here called 3-2-1, and three partners from the Nordics, so coordinated by Tallinn Technopole and two other partners, Business Turku and SweCare Foundation from Sweden, and Business Turku comes from Finland. This is our second US market webinar and called US Market Insights. For today's agenda, first of all, this short opening words explaining what is our project all about, and then we'll got John Pennett, who is partner of the Life Sciences Advisory Group, Eisner Advisory Group. He is explaining about the business steps needed to enter the US market. And then after him, Kimmo Kartono, who is partner at Glassford International and founder of Frontrunner Executive Search, will explain a little bit of how you could find the people you need to work at your company in the US, and just based on the facts and own experiences. And in the end, we will have a short Q&A session. And again, this webinar is recorded, and if you don't have questions immediately in your mind, you can send us the questions later on, and we'll pass these to the presenters. So the project is it's a 3-year long project which started May this year and ends April 2027. Our aim is to support life sciences and medtech, health tech, pharma, and biotech companies, e-health companies, SMEs, small and medium-sized enterprises in Sweden, Finland, and Estonia to expand in the UK and US market. So our KPI, critical or key performance index or indicator, will be that at least 15 of the companies who participate in our project will achieve sales in one of these markets at least. So so what companies will get up to 20,000 worth of EU-funded support in form of market-specific seminars and trainings, so not pure cash. But for SMEs, this is notable that it is not the so-called de minimis support, which is somehow tough to report and at the EU, but this is not this. And it is tailored and personalized coaching. They got sales and lead identification and sales lead development help. They got networking opportunities with Central Baltic companies. We plan to make target export missions, tailor-made export missions, and in the end, they will also get access to trusted local experts and partners, and also ongoing support beyond our business missions as well. So we already had a market introduction first webinar a week ago, and now this is the second webinar in the US. And for you that plan and have not registered in our program, the registration link to our project will be sent to you by email as well. In November, we plan to select the enterprises which will be given the support and which will be able to join our business missions. However, we need to say that also companies can join also later beyond November, but those ones who kind of register on time, they will get, let's say, the most support and have most opportunities to influence our business missions and other, let's say, training webinars. So for your local partners, please contact in Estonia, contact Madli or Merilin. In Finland, contact me, Tero, or my colleague Jyrki, who is, and in Sweden, Anna or Ulf. And you can see this how to apply. The application deadline is November 11th. But as said, you can join also later. So now let's go to the agenda, and our first presenter will be John Bennett, and the floor is yours. Would you like to share your screen or?
Sure. Let me do that.
Thanks.
Okay. Can you see that okay?
Yes.
Okay. Just remember how to do this full screen here. Okay. All right. Terrific. Well, thank you very much for inviting me to come and present. We've got this text on the bottom here, but okay, we'll just have to deal with it. I'm not sure how to take that off. So just by way of brief introduction, my name is John Bennett. I'm a partner at the accounting firm of Eisner Amper. We are about a 4,500 person accounting firm in the US, and we have a couple of offices overseas. I lead our technology and life sciences industry practice. So we serve companies from very early stage all the way up through their venture backing, crossover rounds, and into their IPOs. And I've been doing that for about 40 years. I'm also a member of the Mid-Atlantic Bio Angels, which is an angel network that is a life sciences only tool. So we have companies that present from around the world. We have made investments globally. So I may sprinkle in a comment or two relative to my perspective as an angel investor as well throughout the course of my conversation here. And one of the things that we found throughout the course of our practice is that obviously the U.S. marketplace being one of the largest or the largest marketplace for most items, certainly in tech and health tech and life sciences in general, there was the concept that companies were looking to come to America. So we created a program, and this is a synopsis of the sort of the rules of doing business in the U.S., which will be designed to kind of help you get a little bit of a feel for how things work if you were to start an operation here in the U.S. So our program, which we call our Coming to America program, is a starter program, and obviously we take companies from the start all the way through their finish. So what we've typically seen is that there's a parent company somewhere not in the U.S. Typically, the scenario is that they go for another round of financing. And as part of that round of financing, the venture capitalist suggests to the company, rather than just having 2 part-time consultants and a handful of clients that they never actually get to go visit in the US, why don't they open up a proper company and really try to exploit that? So we usually see it kind of ties to a funding round. In life sciences, we'll also see that being tied to a clinical trial exercise as well. This is my colleague Bob here. Okay, Bob. All right, buddy. Put you down here. Sorry about that. He often likes to participate in these conferences as well. So we see these types of companies, whether they be biotech or technology, e-commerce company, and they come to the U.S. as a starting point under that scenario. And typically, what we'll see is that the company will be set up as a subsidiary, wholly owned by the foreign parent. It is typically set up as what's called a C corporation, as opposed to an LLC. Okay. And it's typically set up as a Delaware entity. Delaware is the most corporate-friendly state as far as the ability to conduct transactions and to protect yourself against lawsuits. So the lawyers will typically, oh, here comes Bob again. All right, you stay there. So usually the lawyers will suggest you set it up as a Delaware corporation. An increasingly popular topic, which you'll see or hear about, is what's called a flip up. So after you've set up that scenario where you have the U.S. company being the operating company, if you come to look into the U.S. in order to get investors, many times an investor will want the company to be a U.S. topco as opposed to a non-U.S. topco. And as a result of that, what happens is essentially is you flip up the subsidiary to become the parent. Now that can be done in a relatively tax efficient manner without too much difficulty. One of the things that is more challenging is if you do decide to do that, you may also wish to migrate the IP to the US, and that can be a little bit more tricky from a taxation perspective. Okay, Bob, you're going to have to leave.
Bob must have a senior management position.
He does. He does. Yes, he is the highest. He is the highest billing consultant we have here. So apologies there. So if you do decide to, so think about this from the perspective, if you do decide to do that flip up in the IP migration, right? So then your local government, your local taxation authority will not have the opportunity to get any profits from your business because the IP is now owned by another company, i.e. the US. So they will typically try to charge some sort of an exit tax or a sale tax if you migrate the IP to the US. So that's a very important point to keep in mind from a negotiation perspective. Where do you set the IP up right from the beginning? Okay. And then
and
as
John,
you think,
I'm
yes.
sorry I interrupt. Can you please say it again? If the IP is transferred to the US company, then what about the IP? Does it also concern the royalties or on the IP?
Yeah, so the IP is going to generate a profit, right? And royalties or whatever the case may be. So whether they have sales or whether they have royalties, in either case, so I'm just going to let Bob out here. So
We will miss Bob.
well, he's not leaving. So he's also the director of critter control for us as well. So apologies. So the owner of the IP is able to generate a profit, right? Either through selling the product or through royalties. Okay. Yeah. So if the IP leaves the country, then essentially you've sold that IP to, say, the US. So your local government, your local tax authority would say, we would like to have, we would like to recognize the profit on that when you sell that. So if you do most things at like a fair value, which is sort of the normal consideration that you would use, what would the IP be worth? If it's worth, $1 million, then your local government would say, so you sold it to the US for $1 million. We would like to get tax on that.
Right, but then who will determine the price of it? And then would that be then a third party? And how would that be then determined versus the from the get-go. I mean, I'm just thinking out loud if the IP is, and this is where I don't mean to like
No, that's
make
okay.
you stuck here. I'm just thinking out loud because, for example, in our case, the IP was developed at the university, and then the university transferred the IP to the company, to a startup. Now, we have a royalty agreement, for example, right? Like many university spin-offs have. And then if you transfer the IP to a U.S. entity, and then this tax is one thing, but the other thing is that will it still be considered that you need to pay the royalty to? Because I guess so.
The
Because
university, because you would license it from the parent company in your home country to you would sublicense it to the U.S. and then your home country tax authorities would say, today, on day one, maybe the IP is worth very little because you're just starting. So the tax on that would be very little times whatever the tax rate is. If you wait a couple of years and now the IP is worth $1 million, and you would have a valuation that would be done by a valuation professional to determine what that fair value would be. And obviously your local government would like it to be as large as possible so they can collect their tax dollars, and you'd like it to be as small as possible so you pay less tax dollars. And the truth is somewhere in between there. Valuation is never a science, it's always an art. So you try to find something that everybody is comfortable with, and you may have to pay that exit tax to go out of it. But the patent would still be owned by the university and just sublicensed to the US in that case.
Right. Thank you.
Okay. All right. Yeah, no problems. Feel free to interrupt anytime here. So the things that we're going to go over here are things that each one of these topics we could spend an hour on, but we're going to spend just a couple of minutes on. So what each company needs in the U.S. is you obviously have to have a bookkeeping system, and you have to keep books and records. There is no statutory audit requirement in the U.S. So many countries have a statutory audit requirement. We do not. You just have to file an annual tax return. That we'll get into that part of it in a little bit later here. So let me just flip over, get to the next step here. So this is sort of the sequence. Now you can obviously start working on the sequence at any time you wish, and you can do all these concurrently, but ultimately this is how things have to be organized. So first you set up the entity. So that's a legal process of setting up an entity in a particular state. Again, typically we see Delaware, C corporations. Okay, so that would be step one. Step two is you have to get a tax ID number from the IRS. If you have a member of your management team that has a U.S. Social Security number, maybe they went to school here or worked here at some point in time, that can be done very quickly. If you don't, you actually have to send a fax to the IRS. During COVID, those fax just sat there unread for months. So that obviously takes a little bit longer. Next step is you have to get a bank account. Hold on one second. All right, now Bob's going to go find us some ice. So next step is you have to get a bank account. There are many banks which do not particularly have an interest in foreign-owned corporations. They like domestic corporations, so you have to find a bank who is comfortable with foreign ownership, and also that the company may be quite small at the very start of the company. Okay. And then the last thing would be you would set up your payroll provider. So if you're going to convert those couple of contractors to, say, employees, you obviously need to have a tax ID number and a bank account first. And we'll talk a little bit about different types of payroll if we have a moment here at the end. Okay. Okay. So a couple things to think about as we get started. So the first thing is, compensation in the U.S. So we are very focused on health benefits. So for perspective, in the New York metropolitan area, if you got a high-end health insurance policy for you and your family, that could be as much as $2,000 a month that you would have to pay. So we're not socialized medicine here. You actually have to pay. So you have to build that into your budgets and it's a very important recruiting tool when you're trying to recruit employees. You don't have to, as a company, you don't have to pay any of it. You could have the employee pay all of it, or you could decide to pay all of it. It's really up to you. There's no particular rules, but obviously the more you pay, the more attractive your offer is. We have a pre-tax retirement plan called a 401k. The money's taken out of your account pre-tax and goes into retirement. Again, an attractive tool. Sometimes companies match a portion of that, again, as a recruiting tool and retention tool. And everybody in the US likes stock options, especially if you're a tech company or a life sciences company. And it's also a very good tool to kind of create alignment of your employees to your long-term goals. So all of those things can be put together as you wish here. Okay. Next topic I want to just touch on briefly is sales tax. So sales tax is obviously most countries have something like that, where you have inputs and outputs and you kind of offset everything. US sales tax is one directional. You are a collection agent for the state. So you charge sales tax on the bottom of your sales invoice. You collect the money from your customer, you remit it to the government. No offsets, no inputs, no other factors go into that. Now, the hard part is to figure out, do you have to charge sales tax or not? So there are 50 states in the US, and there are over 200 cities in the US, each of which has their own sales tax regime, their own sales tax rates, and their own sales tax rules. So I'm going to give you something very simple to think about, but it's obviously very complicated since there are over 200 different answers, and each case is obviously unique. So if you're selling a product to an end user, okay, so not a hospital, not a physician practice, but you're actually selling a product to an end user, you might be subject to sales tax. So SaaS type tools, consumer product tools, or consumer products are typically subject to sales tax, but only if you have nexus. So nexus would be you have a person or an office in a particular state or city. Okay. Or if you have a large amount of quantity of transactions in a particular state. And this goes back to sort of the Wayfair Amazon court cases, which basically said where the Amazon was trying to say, well, we don't have any employees or offices in a small state like South Dakota, so therefore we should not have to charge sales tax and pay income taxes. And basically the Supreme Court said, but there's an Amazon box on every porch every week. So your volume of transactions are too high to say that you're not here. So they've created an economic nexus as well. So super complicated topic, but the key thing for you to remember is ask questions, especially if you're selling to an end user or you're selling a technology. It's more likely that it would be subject to sales tax than if you're selling it through to a distributor. So ask questions, get a good advisor who can help you with that. So one of the key things that happens with respect to this is you have to decide who owns the customer. Okay, so are you going to invoice the customer from your home country, or are you going to invoice your customer from the US? From a sales tax perspective, especially because of the economic nexus threshold that I just mentioned, it actually doesn't matter. So if you have a product that's subject to sales tax and you go over those thresholds, your company in, say, Finland would still have to file the sales tax. They'd have to collect it. You have to register, charge it to your customers, collect it, and remit it every quarter, even if it's done by the Finland company or whatever foreign company. So many companies will decide to put together. They'll say, let's put all those U.S. sales in the U.S. company and just have the U.S. deal with U.S. taxation and not have the mothership deal with taxation in the U.S. The other thing that brings up is what's called transfer pricing, right? So you think about it from this perspective. If the mothership is owning the customers, then what is the function of the U.S.? So it's probably just a sales office, and all the sales are being recorded by the mothership, not the U.S. So then you would essentially recharge the U.S. costs back to the parent. Okay. And because no entity should exist without having a profit motive, the U.S. would say under transfer pricing rules, you should have a small profit here. Okay, not a big deal. On the other hand, if you say, let's put all these sales in the U.S., then we need to move onto the U.S. books cost of goods sold. So the U.S. has to buy the product from the mothership and then sell it in the local market. And those are all sort of dictated by transfer pricing rules. The key thing there is you have to give some thought as to who is going to own the customer. Okay, and obviously you may have contracts already in place. You might have to wait until they expire, and it may take some time. But that's a really important consideration to think about, is who is going to own the customers. It ultimately probably does not matter that much. There is some tax arbitrage in terms of some rates in various countries are lower or higher than the U.S. rates, so there's some opportunity to do some tax planning there. But I would say most people make that decision based upon business conditions more so than tax conditions. Okay. And obviously you should have intercompany agreements and an intercompany loan agreement with your parent company so you can move money back and forth with official documents. Okay. So just a couple last things here. So obviously we have to have books and records. Who maintains the books and records is entirely up to you. That can be done by the accounting department at the mother company. It could be done locally. It can be outsourced, whatever you wish, as long as you have books and records that can support the tax returns and any other filing. Real estate options and insurance options. Real estate is fairly straightforward. I'll skip over that. Insurance, you do need to have a U.S. insurance broker who can help you with things like workers' comp, slip and fall, product liability. So you do need to think about insurance and do need to put that into your budget. Okay. On the employee side of things, so you have a couple different choices, really two main choices, I guess three choices. So you can either just have a payrolling company who processes all payroll for you. They do turnkey solutions. There are many companies who do this. They do an excellent job. And really all you need to do as the company is tell them who to pay and how much, and they take care of everything for you. They take the money out of your account, distribute it to the government and the person as required, and do all the paperwork. So that's great. Oftentimes we'll see companies suggest or talk about going to what's called a PEO, which is a professional employment organization. Okay. What that does is basically you are co-employed, your employees are co-employed by both you and the payrolling company. So what that allows the PEO entity to do is to have large employee health plans, retirement plans, and other employee benefits. And you can use sort of the economies of scale to allow them to do all the management of those insurance premiums and plans and 401k plans and other things. They manage it for you, and they just send you a bill. Okay. Obviously, the larger the company, the more attractive you are to those organizations, since they have to basically onboard your people into their situation. They are still co-employed, so you still have you can still put in place your non-disclosure, non-compete, all the other things. You still dictate the terms and conditions of work. But it does ease the burden of some of the record keeping and benefit administration. The last item that we do see people thinking about is what's called an employer of record. So if you have just a single person you want to put on the payroll here in the US, some people will say, that rather than setting up an entity, why don't we just do it as an employer of record? So essentially that means that you've hired a company to be your contractor, and that company has hired the employee to be their employee. So a tax theoretician would say that's actually not shielding yourself from the responsibilities of registration and having a quote unquote presence in the U.S. But many companies do that as a stopgap solution when they're first getting started. Okay. And the last thing I'll just touch on here is, as your company grows and you migrate and you hire new people and you set up new offices, there is a number of corporate registrations, custom forms, registering to do business, registering to do sales tax, payroll taxes, et cetera, et cetera. So there's a lot of administration, but that's where your providers come into play. So your payroll provider does the payroll side of things. Your corporate team does the corporate registrations and the sales tax registrations. That's part of the things that we operate on a regular basis. Okay. So this is just a very quick summary here of some of those compliance requirements. We've touched on most of these, but this kind of pulls it together in one slide. So we as a firm, we do all of these services here. We partner with payroll companies and other folks as necessary, immigration attorneys, et cetera, to help with things that we don't do. But you need to have sort of a quarterback who helps you manage all these aspects and a shoulder to lean on, because the states and the IRS are they're aggressive. They send out notices, they send out questionnaires, and can be a little disconcerting. So. But at the end of the day, the concepts are not that difficult, and it's a great place to work and operate, and it's certainly great markets. And as long as you've got the right team, you just navigate your way through it. Okay. So I'll stop there because I think I'm just about at time. So and I'll open up, I guess, to any questions, or how do you want to do that?
Thanks, John. As you received already some questions, unless there is someone has a quick question, please go ahead.
Yes, I have a question. Thank you, John. It was a nice presentation. What about the LLC? Because I've heard that LLC might be, or someone has said that LLC might be actually easier to start off in the US and might be. Was the LLC or C Corp? I don't remember now which one was even like more investor friendly, that they're able to kind of take the shares and move them if needed, if you're able to take, or you're planning to take a US investor on board. Yeah. And then you can transition easily to C Corp if necessary, but that's like more for work and more expensive in terms of lawyers and everything else. Can you comment on that?
Yes, definitely. So there are definitely benefits, and I'm going to give the perspective of the topco as opposed to like the operating company underneath the topco, because there's definitely a couple things to think about. So an LLC is a partnership. It is taxed as a partnership, and it's subject to partnership law. Partnership law is way more complicated than corporate law, but here's a couple key things to know. So number one, the partnership does not pay tax. Instead, the profits or losses of the company are distributed out to the partners, and they pay the tax. And it's based upon ownership. So what that means is if you have a US LLC and you have an investor who is, let's say, from Finland, just pick a place, that person in Finland now has a US, it's on a form K1. So they now have a U.S. tax reporting responsibility because they are operating in the U.S. through this partnership. So many foreign investors do not want to pay, if you're not already filing U.S. tax returns, they don't want to. Now they can set up a blocker corporation. It's just another entity to put in between there so they don't have to do that, but it's another entity you have to deal with. and it sort of loses sort of the benefit because you're taxed on the profits of the company. How you distribute out the money, when you distribute the money, or if you distribute the money, does not create a taxable event because you've already paid the tax on the profit. Okay, so you have what's called a single layer of taxation as opposed to the corporate form, where the corporation pays the tax. The U.S. tax between federal and state averages about 30%. So if you have a profit, you pay 30% at the corporation level. Then, if you had any excess cash, you distribute that out to the shareholders, or you distribute out to the shareholders in the form of a dividend, which is also taxed. So that's what's called the double layer of taxation. Okay, and for personal, like relatively high net worth people in the U.S. could be at a 40% tax bracket, maybe even up to 50%. Okay, one of the real big benefits of the corporate form is, one, you don't have to deal with these K1s and these flow through items, right? So the corporation pays its tax. I only would pay tax as an investor if and when I ever get a dividend distribution or I sell the company stock. Okay, so whatever happens in between there, I don't care about per se from a tax perspective. If you are a C corporation and you purchase the shares of that C corporation, and you hold the stock for 5 years, and then sell the stock. So you sell the entire company, all the stock, not an asset purchase, not an out license, but you sell the company in its entirety. You could get up to $10 million of capital gains tax-free. So as a VC investor, that's a huge advantage. So you'll see most VCs, angels, seed investors saying, I would like to invest in a C corporation because if we're successful, I'd like to get at least some portion of that $10 million tax-free.
Mm-hmm.
Okay.
Got
Yeah.
it.
Thanks, John, for a very comprehensive answer. But we need to get going, and our next speaker is Kimmo Kartano, and then Kimmo will tell how you find the right people to grow your business in the US. Would you like to share, or would you like me to share?
Yes, thank you. Let me try to share first. Let's see if we get here. Did it work out?
Yes, just fine.
Okay, great. And yeah, thank you for the opportunity to present, and I'm pleased to speak with you all. This is a brief, fairly superficial presentation, large subject. So I'm happy to talk after hours anytime when you think it might be sort of timely for you. And just briefly about my background, I'm originally from Finland. I've lived in the United States for 30 years. I'm based in Washington, D.C. I have no focus on the D.C. area per se. From a work perspective, I operate across the country. And my background is in executive search and management consulting. Sort of the first half of my career, I was in management consulting, organizational development, and now the last 14 years or so full-time in executive search. And started with a large search firm, global firm, started my own company, Frontrunner Executive Search, LLC, just over 10 years ago. We'll turn 11 early next year. And we work on technology, medical technologies, process industries, materials areas. And our clients are large and small. So from small startups that are developing revenue to multi-billion-dollar corporations, and also as far as medtech, biotech goes, same thing. We worked with startups and large established companies. And we recruit for the leaders, the C-level executives, country managers, general managers who open up business in the US, and also more established operations, and also to mid-level types of positions, particularly sales are typical roles that clients want us to work on. And we are a retained search firm. I'm going to explain that. That's very relevant when dealing with search firms, to understand the two different types of search firms that exist. Our geographic focus is in North America, but as Tero mentioned, I'm also the US partner for global executive search firm Glassford International, and Glassford has about 150 consultants spread in 20 different countries. Most of those countries are in Europe, but we have offices in US, Canada, in South America, and India as well. So briefly about what's going on in the US, state of the economy. It's been going well, certainly been more brisk for quite a few years than Europe. There were some new numbers that came out just today, but they were in line with what I'm saying here. Numbers from September, unemployment about 40%, or 4%. The gross domestic product growth, economic growth at about 3%, and I'm not sure if any European country currently is at that level. Maybe Spain. And annual inflation has gone down as well. And as I said, the new numbers just released today indicate that the strength of the economy goes on. It's good to understand from the macro recruitment perspective that the power balance between candidates and employers has shifted in recent years, and what I'm referring to is that candidates, good, strong candidates, experts, experienced executives, they have a lot of choices where they work, and there's a lot of demand for their skills and qualities. And another thing is younger generation is stepping into the executive suite, and that has brought along also or strengthened the trend towards picking your employers, paying a lot of attention to the values that employers have and exercise and how they operate. So what this means, that companies do really need to present themselves well, and what they stand for, how they operate, explain why somebody should work in our organization. So in the, let's say, some years back, the employer was stronger in that scale, if you will. But US market particularly is extremely competitive. There are a lot of choices, both as employers, but also as employees. So that's what I have observed is somewhat different from the European situation. COVID brought obviously the remote recruitments into new normal. That has continued, although it's not that the debate has not finished. In some ways, it's picking up again, and many companies are trying to attract their employees back to the office, at least part of the time, and some are more successful in that than others. So high demand for top people, like I said, it requires a very concerted effort to go and find those people, and obviously you can't rely on identifying one or even two, but generally you want to have multiple options when you go and build your organization. Role of the CEO also has been sort of transforming from that, and that goes along with the power balance between employers and employees, that now CEOs are also not just issuing commands, but more as a coach and facilitator than who decides single-handedly. In the US, very relevant to keep in mind that there are so many different rules and restrictions, and they are not just in the whole country, but they vary by jurisdiction, and they may vary by state, or they may vary by municipality, the city, or the county. And some of the relevant issues that I'm referring to is how employers need to tell employees at the search phase or interviewing phase what the salary range is. For example, in some jurisdictions, if an opportunity gets advertised, you need to publicly state the compensation parameters. And also, conversely, employers may not be allowed to ask employee what their current package is. So the thinking is everybody deserves what they are worth, and their current compensation or salary is not a measure of what they are worth to a different employer. And here are some real examples of packages, compensation packages, and I'm sharing this just very briefly to bring into your attention that US tends to be an expensive market, and no matter how well people, for example, in Europe know that, and to understand it, sometimes it hits hard when a company actually opens an office and they face sort of the rubber hits the road, and they understand what they do need to pay to attract the right persons into the organization. So here is this is an indicative, let's put it that way. In reality, it could be less, it could be more, but for a small startup organization, it could well be that when a person gets sent or hired in this market, annual base salary 180,000, for example, bonus opportunity in the US is generally much more attractive than in European markets. Yeah, and it can vary a lot. It can vary from 20-30% to 100%, for example. This is just as an example, 40%. Area sales manager, area in parentheses, because area sales manager is a typical title in Europe in many markets. In US, the companies that use that term are usually European, because here it's just a sales manager, or could be a regional sales manager. So the area sales manager term is not particularly common here. And annual base salary for a role like that, which oftentimes does not have direct reports, could be 140, 150,000, and again, bonus potential on top of that. And John was also talking about attracting employees. So if there is stock options, that's obviously an attractive thing to have. It may not be necessary, but it's always certainly valuable to have in your toolbox when you're hiring people. So why it is expensive in the US? Multiple things, and again, John mentioned some things, but the way how I see it, putting it very simply, there is more personal and family responsibility for your family and to take care of what services you need to provide to your family, starting from childcare. Childcare can be easily $30,000 per child per year, for example. Healthcare costs uh, vary greatly, covered partially um, by employers to a different degree, but again, oftentimes the people need to cover more of that expense than in most European markets. Education tremendously expensive, even if it's a public college, for example, where kids go. They might go from 15 to 30,000 a year. Private college could be $50,000 to $70,000 a year per each student. And retirement savings, there is a 401k plan. There are some pension plans, particularly in the older times that companies provided, but more the responsibility is more on personal savings for sure than in European markets. So all these things, course the fact that the compensation might easily be double in the US or even more, depending on situation. So finding people, I've tried to lay out three sort of main things how one can go and find the key people for an organization. And startups, small companies, they will need to decide, okay, what are they going to do, how they are going to do it. So, and here there are three key techniques, if you will. And one is using the colleagues and network, professional and personal networks for recommendations of the right people. And oftentimes people try to do that, and that may involve client base, trade shows, industry conferences, meeting people, asking around, and so on. So that's a good way. It's a very low cost way to do that. There is also sort of trust created pretty quickly because you are in the same business. If you already have a business relationship with an organization, you tend to take that recommendation seriously right from the get-go. There are downsides, cons on that, of course. There is no sort of systematic approach, so it's sort of based on luck if you happen to hear about the right person, and it's likely to be one or a small number of candidates that you were able to track down that way. And when that happens, you really can't know. The timeline when you actually find the right person this way is highly uncertain. Then the do-it-yourself search, which is combination of the previous one, what I just talked about, but perhaps a more systematic approach to actually conducting a more comprehensive canvassing of the market. So doing what the previous, what I was telling about the colleagues and network recommendations, combining it with a more systematic approach. And that might involve either executives doing some of that work and systematically canvassing the market, or there could be somebody assigned, perhaps HR, talent acquisition organization, and the company has already evolved into larger organization and has dedicated people to do that. So in that sense, cost is, let's say, medium, certainly higher than in previous case, but there is a significant opportunity cost, because if executives spend major time on this effort, it's away from something else. and also even if it's a HR organization doing it, same thing, and it's a major effort time-wise to do that. Downside, again, it's a time-consuming. If it's the executive doing the work, it is going to be very distractive and away from the regular responsibilities of building the business. And question is also, is there enough expertise, especially if it's a difficult and complex search? Then the third way, a systematic approach, hiring a retained search firm. And it is, in this case, a retained search firm is somebody, it's like retaining an attorney. So you pay something at the beginning and during the process, and so it's a agreed contract for certain amount of money. It could be a fixed fee or percentage of the compensation, but it's a dedicated, exclusive relationship. You hire somebody to find a certain executive. In this way, the upside is you get many high quality candidates. It's a very comprehensive process that where the market gets reviewed and canvassed carefully. The valuable part is also that the outcome is predictable. A good search firm will deliver the right people and on schedule, pretty much on the estimated schedule. So, and this is not a distraction to the client organization because it's done outside, or it's a minimum distraction. Of course, there are follow-up meetings, and eventually clients will enter into the interview process. But essentially, it lets the business to focus on building the organization and selling to clients. Downside here is it is a higher cost if we talk strictly in dollar terms. And the other downside is if you make a mistake in selecting the search firm, that's obviously expensive. And the other type, when I say retained search firm, that's what we represent, and I'm talking about that only. The other type of search firm is contingency firm, which is important to know. And that's sort of based on the success fee, which gets paid in the end only. So there is no upfront cost, and it might be non-exclusive. So there might be multiple contingency firms conducting a search. So it's kind of, it's not nearly as focused or comprehensive. It's a different process, but wanted to just, it's important to pay attention to that if you are at a situation where you need to hire a search firm, as to understand these two different types. And here is a general recruiting process overview. I'm not going to go through that with you in detail, but this shows generally the steps. They may be tweaked, and they are certainly different in that contingency search type of situation. So this is for the retained search. And these are the principles that we follow as having a fiduciary duty to our clients, and that these are the principles that express our commitment and the level of quality that we want to ensure in delivering candidates for our clients that will be a great fit and help the organization grow. Finally, just sort of summary recommendations. Make sure that when you are ready to enter the US, that you have the resources, understand what the costs are related to building an organization, they're hiring people, getting all those administrative things in place that John was talking about earlier. And again, understand the types of search firms that you are dealing with. Also, it's valuable to, when you start thinking about your strategy of entering their market and how you're going to do it, it does. It's useful to talk with a strong individual, if it's at the search firm or somewhere else, who understands the intricacies of entering the market, because you can then discuss what you need to pay attention to at that time, sort of before you actually do the actions that take you to establish an organization. So you can well involve search firms early on in the process and get sort of those key things understood and thought through carefully early on. And point saying, convey commitment to reassure candidates. So this is especially valuable for startups, which are by definition riskier than old established larger companies. So you need to convey your seriousness and commitment to that market by planning well, having a consistent message, and sort of signaling that you know very well what you're doing and why you want those people on board. So that's I have found that's a very important thing to convince top-notch candidates to join a startup or startup type organization. Thank you very much. I would be happy to answer any questions you may have. If we have time now, great. If we don't, then I'm happy to talk later one-on-one as well.
Thank you, Kimmo. Let's ask first from the audience. Does anyone have a question? If not, I will at least have myself one. So if you have, I don't see your hands, but just ask. Okay, so I got one question. You mentioned about the even a sales manager would get something like 150K annually plus a 30-40% bonus. How much is that salary level differ depending on where you live or where your operations mainly are? So I would imagine that living in New York, Boston, DC area would be more expensive than in Akron or somewhere, Akron, Ohio or Tennessee or.
Yes, that's true. Living expenses are different, but especially when we are talking about the sales, they are often remote positions, so they could be located anywhere. California in technology, especially the Northern California, is expensive. So that's why many technology companies have been moving their operations elsewhere, away from Silicon Valley. But also, like I said, if you are good at what you do, then you command the top dollar, and people who do that, they also know what they are worth, regardless of where they live. So there are some flexibilities on that, but I wouldn't rely on that too much. So expect to pay the full salary to competent people. That would be my
that makes sense. And anyhow, I think it would make sense also for companies to have salespeople where the clients are. So if the clients are in the big cities, so why on earth would you have your sales manager located 300 miles away from them? So
yeah.
Anyhow, thank you, John. Thank you, Kimmo. Thank you for the audience. And for the audience, just to remind you that you will get later on this recording to your email, and we'll try to publish these presentations also on the LinkedIn Health3-2-1 LinkedIn page. Thanks again, and have a nice evening or day.
Thank you.
Thank you.
Very much.
Bye.
Have a
Thank
good
you.
day. Bye-bye.
Bye.